All right, let's dive right in because a massive change could be coming to your wallet. We're going to break down a proposal that could completely reshape how credit cards work here in the US. And believe me, it has kicked off an absolute war between Washington and Wall Street. So, to really get what's happening, you have to start with this number 23%. As of January 2026, that is the average interest rate, the APR, on a credit card. If you've ever carried a balance, you know exactly what that feels like. And just to put it in perspective, for every $1,000 of debt, that's an extra $230 a year just in interest. Ouch. And this is the proposed new reality, a hard cap, just 10%. Now, the idea of capping interest isn't brand new. It actually goes way back to old usury laws meant to stop crazy high rates. But this modern version, it would be a huge shift for consumers. The real question is it a dream come true or the start of something way, way worse? So where is all this coming from? Well, this isn't just one single idea. It's a two-part legislative push from the current administration, and it's aimed at what they're calling a rip-off of the American public. So let's take a look at what's actually on the table here. It's really a one-two punch. First, you've got the 10% interest rate cap for 1 year. It's simple, it's direct, and it's super dramatic. Second, there's the Credit Card Competition Act. The goal here is to break what's often called the duopoly of Visa and MasterCard. It would force banks to give merchants at least one other network choice to process payments, like an Amex or a smaller player, hopefully at a lower cost. And you better believe these two ideas together have the entire financial industry on high alert. And that gets us right to the heart of the conflict. The banking industry is sounding all the alarms, warning that these proposals, which, let's be honest, sound pretty good on the surface, could actually trigger a massive credit crunch. They're arguing it could leave millions of Americans high and dry without access to credit right when they need it most. Okay, to understand their side, you have to get this one key concept: risk pricing. Banks argue that interest rates aren't just pulled out of thin air. You see, a credit card is an unsecured loan. There's no card to repo or house to foreclose on if you don't pay. So that higher interest rate for someone with a lower credit score, that's how they price in the bigger risk that they might not get paid back. This quote from an industry analyst really just nails their biggest fear. The argument is that a 10% cap isn't really a price control. It's an access control. If banks can't charge for taking on more risk, they'll just stop taking risks altogether. And that means they'd pretty much stop lending to anyone who isn't already a top-tier, super safe borrower. So this huge fear of not being able to price for risk, it leads directly to the industry's pushback, which really boils down to three main worries. You can think of them as the three pillars of their whole argument: access to credit, the future of all those rewards programs, and of course, the security of the whole system. So let's break this down one by one. First, you've got reduced access to credit. We're talking about who even gets a card in the first place. Then there's the potential death of rewards programs, all the perks that come with those cards. And finally, the unexpected struggles this could create for small businesses and payment security. Let's dig into each one. The first pillar is all about access. Financial trade groups are basically warning that if they're forced to cap rates at 10%, it just won't be profitable anymore to lend to anyone with a less than perfect credit score. The result? They say they would have no choice but to start closing accounts, and on a massive scale. And they've put a jaw-dropping number on it. Industry studies are estimating that up to 190 million credit card accounts could be severely restricted or just closed, period. This would hit lower-income families the hardest and could potentially push them towards way more expensive options like payday loans. Okay, pillar number 2, the end of rewards as we know them. I mean, all those airline miles, the cashback bonuses, they aren't free. They're paid for by two things: the interest people pay on their balances and the swipe fees that merchants pay every time you use your card. The 10% cap crushes the first one, and the Competition Act is designed to slash the second. It's a total double whammy for the rewards ecosystem. And the third pillar is actually a little counterintuitive. Even though the Competition Act is being sold as a big win for small businesses, a lot of community bankers are arguing it would be a total disaster for them. They say being forced to support a bunch of new processing networks would mean a massive, super expensive overhaul of their security and tech systems, costs that a small bank just can't easily swallow. Now, for a second, let's step away from the rate cap and zoom in on that other proposal, the Credit Card Competition Act, because the debate here is just as fierce. So here's the bottom line. The supporters, who are mostly big retailers, see this as finally bringing some healthy competition to a market that's totally dominated by Visa and MasterCard. But the opponents, the banks, they see it as just introducing chaos, higher costs, and way weaker security. And here is the core disagreement, right here. Retailers are claiming they'll save billions in swipe fees and that those savings could lead to lower prices for you and me. But the banks fire right back with a history lesson. They point to something called the Durbin Amendment from back in 2010. That law capped debit card fees, but studies showed that almost no retailers, we're talking 98% of them, actually passed those savings on to customers by lowering their prices. So let's put it all together and see what this might actually mean for your wallet. Right now, we're in a world with average APRs around 23%, but rewards are pretty good and your odds of getting approved are decent. The proposal would shift us to a world with a strict 10% cap, but with very low approval odds for most people, slashed rewards, and oh yeah, probably higher annual fees to make up for all that lost revenue. So with the battle lines drawn so clearly, the big question is, what happens now? Is this change just around the corner? Well, the short answer is no. A massive fight is really just getting started. Here's the most likely roadmap. The proposals are on the table as of January 2026. The banking industry is already gearing up for a huge lobbying and legal war. Most experts think this isn't something that can be done by executive order, which means it'll need Congress to approve it. And that means this is destined for a long, drawn-out fight in the courts and in the Senate. Okay, but let's make this personal for a second. A really common question is, how does a 10% rate cap actually affect my credit score? And that's a fantastic question, because the impact isn't direct, but it could be very, very real. And here's why. The cap itself doesn't touch your score, but if your bank decides you're suddenly too risky under these new rules and either closes your account or just slashes your credit limit, your credit utilization ratio, that's just the amount of debt you have compared to your total available credit, could shoot way up. And that is something that can cause your credit score to drop, sometimes by a lot. So as we wrap up here, it all comes down to this one fundamental trade-off. On one side, you have the dream of a 10% interest rate, which would be a huge relief for anyone carrying a balance. But on the other side, you have the potential reality of millions of people losing access to credit altogether, and the end of the travel points and cashback rewards that so many of us rely on. And that leaves us with the final question, the one that is truly at the center of this entire debate. Is paying lower interest on your debt worth living in a system where fewer people can get credit in the first place? There is no easy answer here, and how our lawmakers and the courts decide to tackle it is going to change the way we all use plastic for years to come.